Hi dear, welcome to your favorite audiobook channel Wisdom Flicks. How to control emotions in trading. Struggling to keep your emotions in check while trading? Discover the secret to mastering your mindset and turning volatility into opportunity. This audiobook reveals proven strategies to stay calm, disciplined, and in control, because in trading, the calm always wins. Press play and start trading smarter today. Introduction. Why emotions are the silent killer in trading. Trading is not just a game of charts, numbers, and strategies. It is a psychological battlefield where the fiercest opponent is not the market, it's your own mind. Every trader begins with a dream: financial freedom, independence, success. You imagine calm mornings, decisive actions, and steady profits. But very quickly, you realize that trading isn't just about buying low and selling high. It's about managing the emotional chaos that comes in between those 2 points: fear, greed, doubt, overconfidence. These are not just feelings, they are silent saboteurs, and they have taken down more traders than any technical misstep or poor market forecast ever could. You see, the markets are unpredictable. Prices go up and down. News breaks without warning. Trends reverse in the blink of an eye. But your emotional response to all this unpredictability? That's something you can control. And if you don't, the consequences are severe. Consider this. A trader spots a promising setup. All indicators align. But just before entry, fear creeps in. What if this is the wrong move? What if the market turns? They hesitate. They miss the trade. Later, the price shoots up exactly as predicted. Now, regret sets in, and they jump into the next trade impulsively, trying to make up for the missed opportunity. This time, without proper analysis. And just like that, a small emotional slip has spiraled into a string of bad decisions. This pattern repeats again and again until the trader is no longer making decisions based on logic or planning, but purely reacting to emotions. It's subtle, it's gradual, and it's destructive. Emotions are not inherently bad. In fact, they are a core part of being human. Fear protects us from danger. Greed, when channeled correctly, can drive ambition. Even anxiety can keep us alert and aware. But in the trading world, when emotions are not managed, they distort perception, cloud judgment, and erode discipline. Imagine emotions as waves. When you're unaware of them, they toss you around like a ship without a rudder. But when you understand them, when you learn how to anticipate and ride those waves, you gain control. You become the captain of your trading journey. Now, here's the hard truth. Most traders spend months, even years, perfecting their strategies. They study technical indicators, memorize chart patterns, and analyze historical data. But they rarely spend the same energy mastering their emotional responses. They underestimate just how powerful their mindset is in determining their success. And yet, emotional control is often what separates the consistently profitable trader from the constantly frustrated one. This audiobook is designed to change that. You are about to enter a space that goes beyond strategies and signals. Together, we'll explore the emotional landscape of trading. What triggers your responses? How to identify emotional traps? And most importantly, how to stay centered when everything around you feels uncertain. That you'll learn why emotional intelligence is the most underrated trading skill. You'll discover how to develop habits and routines that ground your thinking. You'll hear methods backed by psychology and neuroscience to manage impulses in real time. Because ultimately, the market doesn't care about your feelings. It doesn't reward panic, and it doesn't forgive indiscipline. It rewards those who can remain calm under pressure, those who can execute with clarity, those who can lose without losing their heads. So, if you've ever closed a winning trade too early out of fear, if you've ever held on to a losing position hoping it would turn around, if you've ever chased a trade because you felt like you were missing out, you're not alone. But you also don't have to keep repeating those patterns. This book is your opportunity to break free. By the end of it, you won't just have more knowledge. You'll have insight. You'll have control. You'll have emotional strength, the kind that transforms your trading from chaotic to confident. So take a deep breath, focus your mind, and prepare to master the one skill that will elevate every aspect of your trading life. Emotional control. Let's begin. Chapter 1. The Psychology of Trading. Why your brain betrays you. You enter a trade. Everything looks right. The setup is perfect. Your indicators are flashing green. The chart is moving as expected, and your plan is clear. But as the trade begins to unfold, something shifts, not in the market, but in you. Your heart rate increases. You start second-guessing. You watch the candles obsessively. Every tick begins to feel personal. Before long, you either close the trade too early or let it run too long. And you're left wondering, what just happened? This is where the psychology of trading comes into play. And this is where your own brain, the most powerful tool you possess, can also become your greatest liability. You see, your brain wasn't designed for trading. It was designed for survival. From the time of our ancestors, the brain evolved to keep us alive, not to make financial decisions in fast-paced, high-pressure environments. When you face uncertainty in the market, your brain responds as if you're facing danger in the wild. It releases stress hormones like cortisol and adrenaline. It diverts energy away from rational thinking and pushes it toward instinctual reactions: fight, flight, or freeze. This response is incredibly useful if you're running from a wild animal. But it's disastrous when you're trading financial markets. Let's break this down. The part of the brain responsible for quick emotional reactions is called the amygdala. It's primitive, fast, and emotional. It acts as your internal alarm system. The amygdala doesn't stop to think. It doesn't analyze. It just reacts. Then there's the prefrontal cortex, the rational, thinking part of your brain. It handles logic, analysis, decision-making, and long-term planning. It's the part you rely on when following a trading plan, calculating risk, or deciding when to exit a position. Here's the problem. When emotions are high, the amygdala takes over and shuts down the prefrontal cortex. This is called amygdala hijack. It's why you panic. It's why you abandon your strategy. It's why you make decisions you later regret. Your brain, in an effort to protect you, betrays your trading goals. Now, think about this in the context of a trade that you've entered a position. Suddenly, the price dips. Not a huge drop, nothing abnormal, but just enough to trigger a warning in your brain. Your amygdala lights up. You feel threatened. Your rational brain starts to shut down. Emotion floods in. You panic and close the trade, only to watch the market recover moments later. You didn't lose because your strategy failed. You lost because your emotional brain took over. This doesn't mean you're weak or unfit to trade. It means you're human. Every trader, no matter how experienced, has dealt with this battle. How do successful traders manage it? They don't eliminate emotion. That's impossible. They learn to recognize it, to pause, and to respond with intention rather than reaction. They train themselves to become emotionally aware and to act in alignment with their plan, not their impulses. Understanding this internal conflict between the emotional brain and the rational brain is the first step to mastering emotional control in trading. Let's take a closer look at some of the psychological traps that this internal conflict creates. The trap of loss aversion. Humans are naturally more sensitive to losses than they are to gains. This is known as loss aversion. Studies in behavioral economics show that losing $100 feels twice as painful as gaining $100 feels pleasurable. In trading, this means you might hold on to a losing trade for too long, hoping it will turn around, just to avoid realizing a loss. But hope is not a strategy. And loss aversion blinds you from making clear-headed decisions. The trap of overconfidence. On the other side of the spectrum is overconfidence. After a few wins, especially early on, traders often begin to believe they've mastered the market. This illusion leads to overtrading, taking larger risks, or ignoring stops. The market then delivers a harsh reminder. Confidence without discipline leads to disaster. The trap of FON. There's the fear of missing out, FOMO. You see a stock skyrocketing. Social media is buzzing. Everyone seems to be getting in, and you don't want to be left behind. So you jump in, late, rushed, and without analysis. Often, that's the exact moment the market turns. FOMO is driven by emotion, not logic. And it's almost always a losing game. The trap of revenge trading. After a big loss, another dangerous emotion emerges, the urge to get it all back. This is known as revenge trading. You feel angry, defeated, and desperate to recover what you've lost. So you start taking impulsive trades, doubling down, breaking your rules. But revenge never leads to redemption in trading. It only leads to deeper losses. All of these traps stem from the same source: your brain's natural emotional responses to uncertainty, risk, and pressure. But here's the good news. The brain is adaptable. Through awareness, discipline, and training, you can rewire your responses. You can learn to pause before reacting, to analyze before acting, to stick to your plan even when your emotions beg you to abandon it. This is what separates the professional from the amateur. The professional trader understands that emotions are not the enemy. They are the test. The test of patience, discipline, and self-awareness. And that test begins every time you open your trading screen. In the chapters that follow, you will learn practical techniques to manage these emotions in real time, develop daily habits that strengthen emotional discipline, and build the mental foundation required to thrive in any market condition. Because once you learn to master your mind, you gain something far more valuable than any single trade: the power to trade with clarity, confidence, and calm. And that changes everything. Chapter 2. The emotional triggers in trading. If trading were purely logical, most traders would win. The truth is, it's not the strategy that fails, it's the trader who abandons it. And that usually happens because of emotions triggered by specific, predictable situations. These emotional triggers don't arise randomly. They're built into how our minds respond to uncertainty, risk, and money. Understanding what sets off your emotional responses in trading is one of the most important steps in mastering control. Because when you become aware of your emotional triggers, you stop being a puppet of your feelings and start becoming the master of your decisions. Let's explore the 5 most common emotional triggers that sabotage traders and how to deal with them effectively. Point 1. Fear of losing. The most primal emotion in trading is fear, especially the fear of losing money. Every trader experiences it. Even professional traders feel it. The difference is that pros don't let fear make their decisions. Here's how fear manifests in trading. You hesitate to enter a trade that fits your plan. You exit too early, cutting profits short. You avoid placing trades after a loss. You reduce position size to the point of insignificance, just to feel safe. Fear clouds your judgment. It convinces you that avoiding pain is more important than following your plan. But trading isn't about being safe. It's about being disciplined. You can't eliminate risk. What you can do is manage it intelligently and accept that losses are part of the process. When fear is your trigger, the key is trusting your system more than your feelings. If your strategy has been tested and proven, follow it. Embrace risk, not recklessly, but responsibly. Point 2. Greed. Greed is the second most dangerous emotional trigger. It's sneaky. It often disguises itself as ambition, confidence, or optimism. But unchecked, greed leads to overtrading, overleveraging, and ignoring rules. Here's how greed shows up. You increase your position size after a few wins. You hold a winning trade far beyond your target, hoping for more. You jump into trades you didn't plan for, chasing higher returns. You take multiple trades at once without proper analysis. Greed is fueled by the dopamine rush of winning. It makes you feel invincible, like the market owes you. But the moment you believe you can't lose is the moment you set yourself up to fall. To manage greed, remind yourself of this truth. Your goal isn't to win big, it's to trade well. That means sticking to your plan, taking what the market gives, and walking away with discipline, not desperation. Point 3. FOMO. The fear of missing out. Few triggers are as tempting and destructive as FOMO. The fear of missing out. That you've probably experienced it. You watch a stock or currency pair skyrocket. You didn't enter the trade. Now it's flying, and it feels like everyone else is making money but you. You panic. You jump in late. And more often than not, the market reverses just after you enter. You bought the top. You chased the hype. FOMO trading is impulsive. It's emotional. It ignores your system, your analysis, and your risk management. Here's the truth. You will always miss some opportunities. That's part of trading. The market will always present more chances. But if you chase every move, you'll end up emotionally exhausted and financially drained. The antidote to FOMO is patience and preparation. When you have a plan, you're not dependent on any one trade. When you trust your system, you let the market come to you. That's where real confidence comes from. Point 4. Revenge trading. Revenge trading is emotional trading at its most dangerous. You take a loss. You feel angry, frustrated, embarrassed. You want to make it back, not tomorrow, not later, but right Now, so you enter another trade without analysis, and then another. You double your risk. You abandon your rules. You're not trading anymore. You're reacting. Revenge trading leads to some of the worst losses in a trader's career. It's not about money anymore. It's about ego. The market doesn't care about your ego. It doesn't owe you anything. Trying to get back at the market is like trying to fight the ocean with your hands. To stop revenge trading, you need to build an emotional pause into your process. After a loss, step away. Take a break. Breathe. Analyze. Ask yourself, am I trading with discipline or reacting with emotion? Only return when your mind is clear and your plan is in control. Point 5. Overconfidence after winning wins feel great. They give you a boost. They validate your skill and strategy. But they can also be deceptive. After a series of wins, many traders experience a psychological high. They begin to feel unstoppable. The rules start to feel optional. The risks don't seem as real. This is when overconfidence strikes. Here's how it shows. You increase your position size without adjusting your risk. You skip your usual analysis steps. You trade too frequently, believing everything will work out. You start to believe your gut more than your plan. This false sense of security leads to reckless behavior, and it often ends in a loss that erases all previous gains. The key to managing overconfidence is humility. Every trade is independent. The market doesn't reward streaks. It rewards consistency. After a win, don't loosen up. Tighten your discipline. Remind yourself, winning is not a license to be careless. It's a reminder that my process works. Final thoughts. Awareness is the first step to control each of these emotional triggers. Fear, greed, FOMO, revenge, and overconfidence can take you off course if you're unaware of them. But once you see them, you can begin to take back control. Awareness is the foundation of emotional mastery in trading. The more clearly you can name and notice your emotional responses, the less power they have over you. In the chapters ahead, we'll explore how to build habits, routines, and tools that help you manage these triggers in real time. You'll learn to create a trading environment that supports calm thinking and sharp decision-making, because the market will always test your emotions. But with the right mindset and preparation, you can stop reacting and start responding like a professional. Let's continue. Chapter 3. Build an unshakable trading routine. If emotional control is the foundation of trading success, then routine is the structure that holds everything in place. Emotions thrive in uncertainty. They grow louder in chaos. But when your trading day is supported by clear structure, you reduce decision fatigue, increase discipline, and become less vulnerable to emotional sabotage. Great traders don't rely on motivation or inspiration. They rely on systems. Systems remove the need to constantly feel ready. They create consistency in a world that's anything but consistent. In this chapter, we'll build a complete, practical routine that grounds your trading mind and improves your performance. This isn't about complexity. It's about creating a rhythm that you can trust, no matter what the market throws at you. Let's break your trading routine into 3 key phases. Pre-market preparation. Live trading execution. Post-market review. 1. Pre-market preparation. The mental warm-up. Your trading day doesn't begin when the markets open. It begins with your mindset. Just like an athlete warms up before a game, a trader must prepare mentally before entering the battlefield of the markets. This phase is about reducing emotional noise and aligning your focus. Here's how to do it. A. Mindfulness moment before you open your charts or check your phone. Take 5 to 10 minutes for yourself. Breathe. Sit in silence. Meditate. This simple act of stillness clears mental clutter and sets the tone for a calm day. Ask yourself, how am I feeling right now? Am I carrying stress from something unrelated to trading? What emotional state am I bringing into the market? Self-awareness starts here. B. Review your plan. Revisit your trading plan. Remind yourself of your setup criteria, your risk management rules, your stop loss and take profit strategy, your max number of trades for the day. This is not a suggestion, it's a contract. By reading your plan, you reinforce discipline before emotions have a chance to interfere. C. Check the news briefly. Scan for major economic events or announcements. Avoid getting sucked into headlines or noise. Your goal is to be informed, not distracted. D. Set your intention and your prep with this question. What does a successful trading day look like? regardless of the outcome. For example, a successful day means following my rules, not forcing trades, and walking away with clarity. This mindset shift helps you focus on process over outcome, which is the core of emotional mastery. Point 2. Live trading execution, discipline in action. This is where most traders struggle emotionally. It's where the plan meets pressure, and it's where routine becomes your anchored. Here's how to manage this phase. A. Limit your screen time. Watching every tick of price movement is emotionally exhausting. It leads to overtrading, impatience, and second-guessing. If your strategy allows, set alerts instead of staring at the screen all day. Define how much time you'll spend watching the market. For example, I will only trade between 9:30 and 11 a.m. After that, step away unless there's a reason to return. Boundaries protect your focus. B. Stick to 1 or 2 strategies during live hours. Your job is to execute, not to explore. Don't jump between strategies. Don't try something new because you saw it online the night before. You are here to follow what you've tested. Focus builds confidence. C. Trade fewer, better setups. Not every day is a trading day. Some days, the best trade is no trade at all. B. Why limiting your trades to high-probability setups? You avoid emotional fatigue. It's far better to take 1 quality trade than 5 impulsive ones. Create a filter in your mind. If it doesn't meet my criteria 100%, I skip it. D. Use a checklist before entering a trade. This builds consistency. Before placing any trade, run through a checklist like, does this setup match my strategy? Have I calculated my risk? Is the risk-reward ratio acceptable? Am I acting out of plan or out of emotion? If you can't answer yes confidently to all, don't enter the trade. This habit alone can prevent countless emotional mistakes. D. Step away after each trade. After a trade is complete, walk away, even for just 5 minutes. Why? Because every trade, win or lose, creates an emotional charge. Stepping away allows you to reset your emotional baseline and evaluate the next opportunity with a clear mind. Point 3. Post-market review. The secret weapon. Most traders skip this step, and that's why most traders repeat the same emotional mistakes. Your post-market review is where true growth happens. It's not just about your profit or loss. It's about understanding your behavior. Here's how to do it. A. Log your trades record. Each trade with entry and exit points, stop loss, and take profit levels. Reason for entry: outcome, profit/loss. Emotional state before, during, and after the trade. This turns your trading journey into real data, not just numbers, but patterns of behavior. B. Rate your discipline. Create a scale from 1 to 10 and ask, how well did I follow my plan today? Did I stick to my rules? Did I make any decisions based on fear, greed, or frustration? This rating keeps you honest. Over time, you'll see the correlation between high discipline days and profitable outcomes. C. Reflect. Don't judge if you made a mistake. Don't beat yourself up. Learn from it. Ask, what triggered that decision? What could I do differently next time? What emotion was in control at that moment? Self-compassion combined with accountability leads to rapid improvement. Creating your personalized routine. Now that you understand the 3 phases, pre-market, live trading, and post-market, it's time to make it your own. Your routine should match your schedule, reflect your trading style, be sustainable long-term. Here's an example of a simple, effective daily routine. 8:00 a.m. Mindful breathing and journaling. 8:15 a.m. Review trading plan and key levels. 9 a.m. Light breakfast or walk. 9:30 a.m. to 11 a.m. Focus trading window. 11 a.m. Step away, even if trades are active. 2 p.m. Final review, journaling, discipline. Rating. Evening. No charts. Detach. Recharge for tomorrow. It's not the complexity of your routine that matters. It's the consistency. Final thoughts. Discipline grows in routine. A trader without a routine is like a pilot flying without a flight plan. Vulnerable, reactive, and directionless. When you have a strong routine, you begin each day with clarity. You reduce the number of decisions that depend on willpower. You build habits that protect you from emotional triggers. And most importantly, you give yourself the structure needed to become a calm, focused, and consistent trader. In the next chapter, we'll dive into one of the most powerful tools for emotional control and performance tracking, the trading journal. Let's continue. Chapter 4. The power of a trading journal in the fast-paced world of trading. Your most powerful asset isn't a complex algorithm or a deep market insight. It's your self-awareness. And the best way to develop this awareness? Through a trading journal. This chapter will explore why maintaining a trading journal is one of the most transformative tools for any trader, especially when it comes to managing emotions. It's not just about tracking numbers. It's about understanding your behavior, your patterns, and your psychology. What is a trading journal? At its core, a trading journal is a personal record of all your trades. But it's far more than a spreadsheet of entries and exits. A powerful trading journal includes the setup and rationale behind each trade, market conditions at the time, your emotional state before, during, and after the trade, outcome of the trade, profit or loss, lessons learned from each decision. Think of it as your trading therapist, a safe space to reflect without judgment. Why most traders ignore journaling and why that's a mistake. Many traders skip journaling because they believe they're too busy. The market moves fast, and pausing to reflect can feel like a luxury. Others avoid it because it forces them to confront their mistakes. No one likes looking back at a painful loss or a moment of impulsive decision-making. But this avoidance is precisely what causes traders to repeat the same emotional mistakes over and over again. A journal acts as a mirror. It reflects your tendencies and weaknesses so you can address them head-on. The psychological edge. Keeping a journal trains your brain to detach from the outcome and instead focus on the process. That shift is crucial. Without a journal, a winning trade might feel like a validation of your skill, even if it was a reckless decision that just happened to work out. A losing trade, on the other hand, might feel like failure, even if you followed your plan perfectly. This kind of distorted feedback reinforces bad habits and punishes good ones. Journaling allows you to evaluate your trades based on execution, not just results. That's how professional traders think. They know that success in the markets is about consistency, not just individual wins. Emotional awareness through writing. One of the most underrated aspects of journaling is emotional tracking. You begin to notice patterns. Do you take bigger risks after a loss? Do you abandon your strategy when you're anxious or stressed? Do you feel invincible after a winning streak? Writing down your emotional state before and after trades allows you to identify the mental states that lead to poor decision-making. Over time, this awareness builds emotional discipline. What to record in your journal to get the full benefit of a trading journal? Be detailed. Here's a template you can use. Date and time. When did you enter and exit the trade? Market conditions. What was the market doing? Trend, volatility, news. Trade setup. Why did you take the trade? Was it based on a specific strategy or intuition? Entry and exit points. At what price did you enter and exit? Stop loss and target. What were your predefined risk and reward levels? Outcome, profit or loss. Emotional state, before, during, after. What were you feeling? Calm, anxious, greedy, fearful? What went right/wrong? Did you follow your plan? What you learned. One key takeaway from the trade. Consistency is key here. The more trades you record, the more data you'll have to identify your personal trading behavior patterns. How journaling creates accountability. One of the greatest dangers in trading is self-deception. It's easy to rationalize a poor trade in the moment, but when you know you'll have to write it down later, it forces you to think twice. This creates self-accountability, which is the foundation of discipline. Your journal becomes your internal coach, guiding you to stay aligned with your system rather than your emotions. Tracking progress and improvement. The journal isn't just about identifying problems. It's about recognizing growth. When you've been journaling for weeks or months, you'll begin to notice fewer emotional trades, better risk management, greater confidence in your system, reduced overtrading, increased resilience after losses. These small improvements compound over time, turning you into a more stable, methodical, and profitable trader. Real-world example. Let's say you notice through journaling that you tend to overtrade on Fridays. Maybe you're trying to make up for a bad week, and you end up taking impulsive trades that deviate from your strategy. With this awareness, you can implement a new rule. Only take trades on Friday if your criteria are met with absolute clarity. Or perhaps avoid trading on Fridays altogether. That single change, brought to light through journaling, could save you thousands over time. Digital versus paper journals. There's no best format for a trading journal. Some traders prefer the classic pen and paper method because it feels more personal. Others use digital tools like Notion, Excel, or specialized apps like Edgewonk or TraderSync. Choose whatever format you'll stick with. The real value is in the habit, not the tool. Turning reflection into routine journaling should become part of your daily routine, just like brushing your teeth. Set aside 10 to 15 minutes after the trading day to review and write. If you make it a non-negotiable habit, your trading psychology will strengthen day by day. You'll start to anticipate emotional reactions and manage them proactively instead of reacting after the fact. Summary: a small habit with huge impact. Most traders search for the next big thing, a better strategy, a faster charting tool, a secret indicator. But the truth is, trading success often comes down to the basics done well. And journaling is one of the most powerful basics you can master. By documenting not just your trades but your thoughts, emotions, and decisions, you build emotional resilience, sharpen your discipline, and take full control of your trading behavior. The journal doesn't just record your journey, it shapes it. Chapter 5: Techniques to Regulate Emotions in Real-Time Trading is a high-pressure, high-stakes activity. Even the most experienced traders are not immune to sudden emotional spikes. Fear during a rapid market drop, greed during a bullish surge, frustration after a loss, or overconfidence after a win. These emotions, if left unchecked, can lead to impulsive decisions that derail your strategy and threaten your capital. That's why learning to regulate emotions in real time is crucial. In this chapter, we'll explore powerful, practical techniques that can help you stay calm, composed, and in control exactly when you need it most. Point 1. Deep breathing. Reconnect with the present. It sounds simple, but it's incredibly effective. Deep, controlled breathing triggers your parasympathetic nervous system, the part responsible for calming your body and mind. When you feel a surge of panic, excitement, or tension, take 60 seconds to breathe deeply. Try this method. Inhale slowly for 4 seconds. Hold the breath for 4 seconds. Exhale slowly for 6 seconds. Repeat for at least 5 to 6 cycles. This technique interrupts the emotional spiral and helps you center your focus. It brings you back to the present moment, where logic has a chance to regain control. Point 2. The pause and label technique. Awareness is the first step to regulation. When you start feeling emotional, pause. Don't place a trade. Don't click anything. Just stop and mentally label the emotion. For example, I'm feeling anxious. I'm getting greedy. I'm frustrated from that last loss. By labeling the emotion, you shift activity from the amygdala, the emotional brain, to the prefrontal cortex, the rational brain. This cognitive switch gives you just enough space to reconsider your reaction and stick to your trading plan. Point 3. Use a reset ritual. Professional athletes have rituals. Before every serve or shot, they reset their mind and body. Traders can do the same. Design a simple routine that helps you recenter after an emotional surge. For example, step away from the screen for 2 minutes. Take a sip of water, stretch, or walk around your room. Glance at your trading plan or journal briefly. This reset ritual gives you a break from the emotional environment, so you don't carry stress from one trade into the next. Point 4. Set pre-planned breaks. The market never stops, but you must. Emotion builds over time. Even if each trade is small, the emotional residue accumulates. That's why scheduled breaks are essential, especially during high volatility periods. How to do it? Every hour, take a 5-minute break, even if you're in the zone. Use a timer or a software tool that nudges you to pause. Avoid analyzing charts during breaks. Truly disconnect that you'll return with fresher eyes and a calmer mind. And more importantly, you'll be less likely to fall into emotional loops. Point 5. Create a real-time emotional checklist. Professional traders don't just review the markets, they review themselves. Have a quick emotional checklist ready and ask yourself before placing any trade. Am I trading based on a clear setup? Am I following my plan or reacting emotionally? What emotion am I feeling right now? If I saw another trader doing this, would I approve? Running this checklist in real time keeps your emotions in check and brings clarity to your decisions. With practice, it becomes a habit. Point 6. Leverage visualization before trading. Before your session begins, close your eyes and visualize different trading scenarios. Imagine both wins and losses, and see yourself reacting calmly and rationally in each case. Here's a sample visualization. I place a trade, and it hits my stop loss. I take a deep breath, accept the loss, and move on without revenge trading. This kind of mental rehearsal conditions your brain to respond with discipline. Just like pilots run simulations before flying, traders benefit from visualizing tough moments in advance. Point 7. Limit exposure after emotional surges after a big win or a painful loss. Your emotional state is unstable, even if you don't notice it immediately. In these moments, reduce your position size or pause trading altogether. Winning streak. You may be tempted to go all in. Losing streak. You may feel the urge to make it all back. Both mindsets are dangerous. Use these guardrails. Set a rule. If I have 2 consecutive losses, I take a 15-minute break. After 2 big wins, I lower my position size for the next trade. Never let excitement dictate risk. Think of these as emotional speed bumps. They prevent reckless acceleration. Point 8. Use technology as an emotional shield. Automation can help you stay objective. Use tools like stop loss and take profit orders to exit trades without emotional interference. Alerts to signal when conditions are met instead of watching charts obsessively. Position sizing calculators to ensure you're not overexposed when emotions push you to risk more. Let technology handle the mechanics so your emotions don't hijack them. Point 9. Practice self-talk. Become your own coach. The way you talk to yourself in real-time matters. Negative self-talk, like "I always mess up" or "I knew I shouldn't have done that," can spiral into poor decision-making. Replace it with constructive internal dialogue. Breathe. Stick to the plan. This loss is part of the game. Stay focused. I'm not here to be perfect. I'm here to be consistent. Your inner voice can either break you or build you. Train it to be your coach, not your critic. Point 10. End the session with reflection, not reaction. How you end your trading session affects the next one. Don't shut your computer in frustration or go on a victory binge. Instead, review your emotional performance. Write down how you felt during trades. Identify what helped and what hurt. This ritual of reflection over reaction rewires your brain for long-term emotional mastery. You're not just logging numbers. You're sculpting the trader you're becoming. Final thoughts. Real-time emotional regulation isn't about suppressing emotions. It's about learning to observe, understand, and manage them, especially when the stakes are high. These techniques won't eliminate emotions, but they will help you trade above them. With practice, you'll go from being a reactive trader to a resilient one. And in the world of trading, emotional resilience is your greatest edge. Chapter 6. Discipline over emotion. The trader's superpower. Discipline in trading is often viewed as a skill, but in reality, it's a superpower. It's the invisible thread that ties together consistency, patience, emotional regulation, and long-term success. Where emotions can be erratic, loud, and short-sighted, discipline is quiet, methodical, and enduring. In this chapter, we'll explore why discipline is the single most important trait of a successful trader, how to develop it, and how to maintain it through the highs and lows of the market. The illusion of control versus the power of self-control. Most traders enter the market thinking they need to control external events, the price action, the trend, the news. But the truth is, you can't control the market. You can only control how you respond to it. Discipline is self-control in action. It's choosing to follow your rules even when your emotions are screaming at you to break them. It's staying out of the market when conditions are uncertain, taking profits when it's time, even if the chart tempts you to hold longer, and cutting losses without hesitation. Discipline is the line between amateur decisions and professional execution. Why emotion craves action, and how discipline counters it. Emotions demand immediate action. Fear wants you to close the trade too early. Greed urges you to over-leverage. Frustration tempts revenge trading. But discipline pauses. Discipline acts like a brake pedal for your impulses. When you've built the habit of disciplined trading, you don't act on the first feeling that hits you. Instead, you take a breath, consult your trading plan, and decide. From a place of logic, not emotion. Over time, this gap between emotion and action widens, giving you the upper hand. The rules that rule you. The best traders don't rely on willpower in the moment. They rely on systems. They create a set of clear trading rules and follow them with military precision. Here are a few examples of discipline-driven trading rules. Only trade setups that meet strict criteria. Risk only 1 to 2% of your capital per trade. Never enter a trade without a stop loss. Do not trade when emotionally compromised, angry, tired, or distracted. Close the platform after a set number of trades or time duration. Discipline isn't something you do occasionally. It's how you show up every day. It turns trading into a repeatable process, not a series of unpredictable gambles. Delayed gratification. The DNA of trading success. The trading world is filled with stories of overnight success, but the truth is much less glamorous. Long-term trading success is built on the principle of delayed gratification. You must be willing to sacrifice the excitement of impulsive wins for the consistency of small, strategic gains. Discipline teaches you to trade not for excitement, but for edge, not for thrill, but for progress. And when you do that, you stop looking at trading as an emotional roller coaster and start seeing it as a business. How to build discipline like a muscle. Discipline isn't just a personality trait. It's a habit. Like going to the gym or eating healthy, it requires daily effort. Here's how you can train yourself to become a disciplined trader. Start small. Don't overwhelm yourself. Begin by following one simple rule religiously, such as using a stop loss in every trade. Track your behavior. Keep a log of moments where you honored or broke your discipline. Reviewing this builds accountability. Reward consistency. Celebrate consistency over profitability. This reinforces the behavior you want to repeat. Limit exposure. Don't sit in front of the screen all day. Set clear trading hours and step away once they're over. Rehearse scenarios. Mentally walk through tough emotional situations and decide in advance how you'll respond. This trains your brain to prioritize discipline over impulse. Real discipline is boring, and that's a good thing. Great trading isn't supposed to feel like skydiving. It's supposed to feel boring, predictable, repetitive. That's where consistent results are born. If your trading style excites you every day, chances are you're over-trading, over-leveraging, or chasing. Disciplined traders learn to love the routine. They thrive in the structure. They understand that boredom is not a problem. It's a sign they're on the right path. When discipline saves you, imagine this. The market takes a sharp turn. You're tempted to hold on to a losing trade, hoping it'll reverse. But your rules say to cut losses at 2%. You follow them. The price keeps falling. You just saved yourself from a major drawdown. Or maybe you've had 3 losses in a row. Your emotions beg you to win it back. But your trading rules say to stop after 3 consecutive losses. You obey. You walk away. You protect your capital and your mindset. That's the power of discipline. It doesn't just protect your money. It protects your confidence, your focus, and your long-term future. The true edge in the market. Indicators, chart patterns, and news analysis all matter, but they are not your edge. Your real edge is your behavior. It's how you manage risk, how you stay calm under pressure, and how consistently you execute your plan. And at the heart of all that, discipline. It's what separates those who hope to be traders from those who are. It's the force that keeps you grounded during chaos and humble during success. It's your shield, your compass, and your greatest advantage. Final thoughts. Emotions will always be a part of trading. You can't eliminate them, but you can control how you respond to them. Discipline is the way you do that. It's not loud. It's not flashy, but it's unshakable. In the world of trading, where fortunes can rise and fall in moments, discipline is the one thing that doesn't move. And when you build it into the core of who you are as a trader, everything changes. Chapter 7. Rewire your beliefs about money and loss in trading. Your beliefs about money and loss shape every decision you make, often without you even realizing it. These deep-rooted ideas influence how you react to winning and losing trades, how much risk you're willing to take, and whether you panic or stay calm in volatile markets. In this chapter, we'll uncover how your mindset about money and loss might be sabotaging your trading performance, and how to reprogram it for long-term success. Point 1. Understanding the money narrative you inherited from a young age. Your environment has been shaping your perception of money. Maybe you heard things like, money doesn't grow on trees, rich people are greedy, or losing money is failure. These phrases may seem harmless, but they embed powerful emotional associations, fear, shame, scarcity, that directly affect your trading decisions. As a trader, your job isn't just to predict price movements. It's also to become aware of how your internal programming influences your reactions to those movements. You cannot afford to let childhood money scripts guide grown-up trading decisions. Ask yourself, what do I believe about money? Do I fear losing money more than I enjoy gaining it? Do I feel guilty when I win big? The goal is awareness. You can't change what you're not aware of. Point 2. The dangerous myth of avoiding losses. Most traders are driven more by the desire to avoid losses than by the desire to make gains. This is known as loss aversion, a cognitive bias identified in behavioral finance. According to studies, losing feels about twice as bad as winning feels good. This creates a dangerous loop. Fear of loss leads to hesitation, overcorrection, or premature exit, all of which erode your edge in the market. That if you treat every trade as a personal success or failure, you set yourself up for emotional burnout. Instead, you must redefine your relationship with loss. Losses are not a verdict on your intelligence or ability. They're simply part of the game. Even the best traders lose. The difference is that they lose with discipline, not emotion. Point 3. Transforming limiting money beliefs. To rewire your beliefs, you must first challenge the old ones. Here's how. A. Identify the core belief. Example: if I lose money, I'm a failure. B. Interrogate its truth. Ask, is this belief absolutely true in all circumstances? What evidence do I have that disproves it? C. Replace it with a new belief. New belief: losses are part of a statistical process, not a reflection of my worth. Repeat this process consistently. Just like reps in the gym build muscle, reps in mindset rewiring build mental strength. Point 4. Redefining success in trading. Most traders measure success by how much money they make. This approach is toxic because it attaches your self-worth to your P&L. It's also short-sighted. Trading is a long game, and short-term outcomes don't always reflect the quality of your decisions. Instead, define success by how well you followed your strategy, how calmly you executed under pressure, how consistently you journaled and reviewed. When you measure success by process, not just profit, you detach your ego from each trade. This emotional distance is what allows professionals to stay cool and composed while others spiral. Point 5. The scarcity versus abundance mindset. Scarcity mindset says, opportunities are limited. If I miss this trade, I'll never get another chance. I have to make this work or I'm doomed. Abundance mindset says, the market will always give more opportunities. Missing a trade is fine. I'm here for the long haul. Every trade is just one step in a much bigger journey. Traders with a scarcity mindset overtrade, chase setups, and force results. Traders with an abundance mindset wait patiently, trade with precision, and grow steadily. Choose abundance. Point 6. Detach from the outcome. Fall in love with the process. You cannot control the outcome of any single trade. You can only control your preparation, your plan, and your execution. Obsessing over outcomes creates emotional spikes. Euphoria when you win, despair when you lose. This roller coaster drains your energy and clouds your judgment. Instead, fall in love with crafting clean, logical trade setups, managing risk like a pro, journaling your thought process. The more emotionally neutral your process becomes, the more consistently profitable you'll be. Point 7. Mental rehearsal. Reinforce empowering beliefs. Neuroscience shows that the brain doesn't differentiate much between real and vividly imagined experiences. Use that to your advantage. Each day, take 5 to 10 minutes to visualize you executing trades with calm focus, you accepting a loss with clarity and professionalism, you following your routine with confidence. Repetition rewires belief. Mental rehearsal programs your subconscious to react with control, even under pressure. Point 8. Mantras and affirmations for traders. Used correctly, affirmations can help reinforce new, empowering beliefs. Say them out loud or write them daily. Examples: I am a disciplined and patient trader. Losses do not define me, they refine me. I trust my system and I follow my rules. Speak them not as a wish, but as a fact. Your brain needs consistency to form new emotional associations. Final thoughts. The inner game defines the outer game. You may have all the technical tools in the world, but if your beliefs about money and loss are rooted in fear, shame, or scarcity, you'll sabotage yourself over and over again. Rewiring your beliefs isn't about tricking your mind. It's about aligning your thinking with reality. Trading is a game of probabilities. Wins and losses are part of the process. Your job is to stay emotionally grounded through it all, master your mind, and the market will follow. Chapter 8. Become the emotionally intelligent trader. Emotional intelligence isn't just a buzzword tossed around in psychology or corporate meetings. For traders, it's a critical edge. Emotional intelligence, your ability to recognize, understand, and manage your emotions, can be the single greatest factor that separates consistent winners from erratic, emotionally driven traders who blow up their accounts. This chapter will walk you through what it means to become an emotionally intelligent trader and how you can develop this superpower to gain control over your decisions, improve consistency, and thrive in the fast-moving world of trading. Point 1. What is emotional intelligence in trading? Emotional intelligence, EQ, is your internal guidance system. It's what helps you pause before reacting to a loss, recognize when greed is influencing your position sizing, or step away when fear is clouding your judgment. EQ in trading includes self-awareness, recognizing your emotions in the moment, self-regulation, managing impulsive reactions to those emotions, motivation, staying focused on long-term goals over short-term gratification, empathy, understanding how other traders think and react, helpful for anticipating market sentiment, social skills, collaborating and learning from mentors, communities, and fellow traders, where IQ might help you understand the markets. EQ helps you understand yourself in the markets. Point 2. The self-awareness audit. You can't control what you don't understand. Self-awareness begins with observation. Ask yourself, what emotions show up when I win a trade? When I lose? Do I feel pressure to prove something through trading? Am I revenge trading or over-trading when things go wrong? To increase self-awareness, use your trading journal not just to record setups and outcomes, but to track your emotional state before, during, and after each trade. Meditate or take quiet moments before the market opens to check in with yourself. Are you calm? Anxious? Overconfident? Awareness is your first line of defense. Point 3. Mastering self-regulation. Self-regulation doesn't mean suppressing your emotions. It means channeling them wisely. If you feel fear, it may be because your position is too large or you've entered a trade without a clear plan. If you feel euphoria, you may be tempted to get reckless and break your rules. Here's how to build self-regulation. Create if-then rules. For example, if I lose 2 trades in a row, I will stop trading for the day. Implement cool-down routines. Step away after a big win or loss to reset emotionally. Use breathing techniques or visualization when under pressure to bring your nervous system back to baseline. Over time, you'll learn to respond to market chaos with calm, calculated action instead of emotional reactivity. Point 4. Motivation that outlasts. Emotions. Every trader dreams of making life-changing profits. But real success comes from doing the hard, boring work even when you don't feel like it. To stay motivated with emotional balance. Define your why. What's your deeper reason for trading beyond money? Celebrate process goals. Instead of celebrating profits, reward yourself for following your rules, journaling consistently, and improving execution. Track long-term progress. A losing week doesn't define you. Look at the bigger trend in your trading journey. The emotionally intelligent trader is driven by discipline, not dopamine. Point 5. Develop empathy for the market. Empathy might sound strange in the context of trading, but understanding the emotional behavior of other traders gives you a serious edge. Ask yourself, is this price movement based on logic, or is it driven by panic or euphoria? Where are retail traders likely to enter or exit emotionally? How are institutional players manipulating sentiment? By seeing the market as a reflection of mass psychology, you'll be less likely to get caught in the traps set by crowd emotion. You begin to think in probabilities, not personal narratives. Point 6. Build emotional resilience over time. Emotionally intelligent traders don't become immune to fear, frustration, or greed. Instead, they become more resilient. Here's how to strengthen your emotional core. Get feedback regularly. Talk to mentors or trusted trading peers about your behavior and mindset. Study your past mistakes with curiosity, not shame. Every emotional failure is an opportunity to grow. Invest in personal growth. Read, reflect, and build strong habits outside of trading that keep you grounded. The longer you trade with awareness and intention, the more bulletproof your mindset becomes. Point 7. Emotional intelligence is a daily practice like physical fitness. EQ isn't something you master once. It's something you practice every day. Make emotional intelligence part of your trading routine. Before you trade, do a mental check-in. During trades, notice emotional shifts without reacting impulsively. After trading, reflect on your emotional state and decisions. These daily moments of mindfulness add up to long-term mastery. Final thoughts in the battlefield of trading. Your sharpest weapon isn't your indicator, your strategy, or even your account size. It's your ability to control yourself. The emotionally intelligent trader is calm in chaos, consistent under pressure, and always learning. You don't need to be emotionless. You need to be emotionally wise. When you develop emotional intelligence, trading becomes less about chasing money and more about achieving peak performance. Day after day, trade after trade. You are your biggest asset. Train your mind, and the market will follow. Final words. The calm wins the race as we close this journey through the complex and often turbulent world of trading emotions. One truth stands clear. Calmness is the ultimate competitive advantage. Markets are unpredictable, fast-moving, and emotionally charged, but those who cultivate calmness, not speed or bravado, are the ones who endure, grow, and ultimately succeed. Why calmness matters more than anything else in trading. Moments of chaos are inevitable. Prices spike or plunge without warning. News headlines ignite fear or greed, and the pressure to act can feel overwhelming. Yet, amid this chaos, calmness serves as an anchor. When you're calm, your mind sees opportunities more clearly, executes plans without hesitation, absorbs losses without panic, resists impulsive decisions driven by emotion. Calmness allows you to think deeply rather than react impulsively. It's the difference between a trader who survives and one who thrives. Patience and persistence. The slow and steady advantage. The market doesn't reward impatience. It punishes recklessness and rewards those who are methodical and patient. Like a long-distance runner, trading success is about endurance, staying the course day after day, trade after trade. Calmness fosters patience. When you're emotionally steady, you wait for the right setups. You accept that some days offer no edge, and that's okay. You persist through losing streaks without losing yourself. Emotional mastery is a continuous journey. Remember, calmness is not a one-time achievement, but a lifelong practice. Markets will always test your nerves. There will be days when fear, greed, or frustration rise up strongly. The key is not to eliminate emotions. They are part of being human, but to master how you respond to them. Every day you choose discipline over impulse, reflection over reaction, and calmness over chaos. You strengthen the foundation of your trading career. The calm trader sees what others miss in the frenzy of the markets. Many traders act on emotion, noise, or the herd mentality. The calm trader, however, operates from clarity and balance. This allows them to spot opportunities others overlook, avoid traps others fall into, and execute with precision when others falter. Calmness turns volatility from a threat into a tool. Final encouragement. Whether you are just beginning your trading journey or are years deep into it, carry this lesson forward. Success is not about being the fastest or the loudest. It is about being the calmest. By mastering your emotions, building discipline, and committing to continual growth, you give yourself the greatest edge possible. The race in trading is long, challenging, and often unforgiving. But remember, the calm wins the race. Thank you for allowing me to guide you through this essential aspect of trading mastery. May your trading be steady, your mind clear, and your success enduring.